There are so many different theories of how people invest. You listen to one guy, he says you should be doing this. You listen to someone else, they say you should be doing this. And it's okay. There's different ways to invest, different ways to look at things. But does a company have to have profits in order for you to invest in it? That's exactly what we're going to cover in this video. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. Sometimes I come across a statement or a philosophy that when you invest in companies that don't have profits, you're not investing, you're speculating. And speculating has this negative tone to it, right? As if you're gambling. And because I'm involved in small companies, microcap companies, it is not unusual to be involved in companies that might not be profitable yet. And so that characteristic alone, is this something that you should say, oh, I'm never going to touch these companies because they're not profitable? And you see, there's no clear answer to this. There's no right and wrong, because it just depends. It depends on so many different things. It's hard to just put things into a certain bucket. Think about how a business is formed. Let's say you start a business that's mowing grass business, landscaping business. Are you going to get clients before you have equipment, before you have all of these mowers? Are you going to get clients? No. You have to invest in an infrastructure, right? You have to get a bunch of, or maybe one. You're not going to mow the grass with scissors, right? Hopefully you're not going to mow grass with scissors. So you have to get most likely a professional equipment. Like one of those can run you $20,000, but you have to invest in the equipment. You have to put up the money, and then you have something to offer, right, to your clients. Because why would a client hire you to mow grass for them? Well, okay, they don't want to do it themselves, but a lot of times it's because they don't have the equipment to do it themselves, and they want to just outsource it. And it's the same with all kinds of businesses. You go and you hire people, let's say, to fix your car, because they have equipment and knowledge to do this. So they had to invest in the equipment, they had to invest in their knowledge and their skills, and then they have something to offer, right? That's how businesses are formed. Somebody has to put up the money up front, and then over time, as the clients get added, more employees get added, the revenues grow, and then hopefully at some point the company becomes profitable, right? So there's this growth path or development of any business, and people who just say the company doesn't have any value until it generates EBITDA or until it generates profit, I'm not sure they understand the full development of the business. Now, it's fine if they want to invest in profitable companies. There's nothing wrong with this. But that's a choice. That's a category of investor that you are. When the companies become mature and to reach a certain stage of their business development, they have to generate profits, and then they attract a certain group or certain style of investors that want to invest in those kinds of companies. But just because you invest in maybe early stage companies or early part of the business development, that doesn't necessarily make you a speculator. Because take a look at a company like Globex, and let's not argue here about whether you believe in the thesis or you don't believe in the thesis. Let's just say that this is what the plan is. This is where the company is going, okay? And if you really want to argue, just put your comments below and just express yourself. But for now, if you look at a company like Globex, they went from like 0, maybe like 20 subscribers last year to its email and messaging platform. And now, as I'm making this video, and you already saw the press release that the company had a few days ago, they have about 5,000 subscribers, right? And it's not too far away from the company having 10,000 subscribers. And I think that 10,000 subscribers is like a major milestone, because at that point, with 10,000 subscribers, the company will be able to generate about $1 million of revenue per year. So imagine if you owned this business. 10,000 clients, that's a pretty serious business, especially if you own a business like this individually. So wouldn't you like to own a business that generates $1 million of revenues? And you can run this business with half of expenses. You can structure it in a way that your expenses are $500,000 a year, $1 million in revenue, and you have a business that generates $500,000 a year in net income. So you have a business that has $1 million of top line, $500,000 of expenses, and it can generate a profit of $500,000 per year. What's wrong with this business? Nothing. Nothing is wrong with a business like this. Pretty good gig, okay? But now, that's not what is the best utilization of the business, right? Because it would be a shame to say, this is where we're going to stop. Because the total addressable market for a business like this is huge, right? You can, in your head, you can say millions of people might potentially be interested in having a private email and communication platform. So if you want to reach more people, then you can have a choice. You can make a choice and you can say, you know what? Yes, I can have this business all for my own, generating $500,000 per year, and I can, go on vacation, play golf all day long. Or I can say, you know what? I'm going to take every penny from that business and I'm going to put it back into marketing, okay? And I'm going to show zero profit. I'm going to show maybe even negative profit, because I might sell some of the business to partners by issuing more shares to put more money into growing that business, because I think it's going to grow much bigger. So it's a choice that I'm making to make this business unprofitable, because I'm not interested in generating $1 million of top line. I'm interested in generating 10 million, 100 million, or maybe even $1 billion of top line growth, because at that point, that business can make me a billionaire, right? I mean, look, if you own that business and it generated 100 million of revenues, and that was like it, you couldn't generate any more. And if, let's say, you could still operate it with 50% profit, net profit margin, that $50 million of net income, and let's not argue whether it's possible or not, that $50 million of net income could very easily be worth 500 million or maybe even $1 billion, depending on what multiple you want to put on it. So because you're sacrificing the current profitability for the future growth, you can potentially become a billionaire, right? And that's the idea behind a business like this. So should you say, I'm not going to invest in a business like this or any business like this unless I can see a positive net income? Well, okay, you can make a choice like this, but then you can miss out on huge growth opportunities, huge money-making opportunities, because you are so close-minded and you don't understand how businesses operate. You don't understand how business can sacrifice the current profitability for the future growth, which makes the whole company more and more profitable and makes it more and more valuable. Also, another factor in this is what kind of a business is it? Because some businesses can have a choice. Some businesses make a conscious choice of sacrificing current profitability so that they can grow. Other businesses, they are such low quality businesses that no matter what they do, they don't have path to profitability. And path to profitability is another factor that when you look at businesses that maybe right now they're not profitable, but do they have a path to profitability? That's important. And in this case, you might look at something like Voxter and you might be like, okay, today it's not profitable, but does it have path to profitability? And if you understand the thesis, then you're like, yeah, I can clearly see the path to profitability. But you know what? I'm not going to worry about it too much today because I can see down the road where it's going. And also another factor that people should consider is the type of shareholders that are part of the company, and whether the company has exciting future, not just total addressable market, but exciting future, and whether the shareholders believe in the future. You see, I have another company that I'm involved in that's not part of the YouTube channel, but it's part of Microcap Explosions, which is my fourth biggest position, and I want to keep adding money to it. It's another example where it's a company that has a number one product in its space, and it's winning customers every single day. And as long as that dynamic stays in place, as long as they keep being dominant in their sector, then the current shareholders are going to excuse the no profits today, because again, they can see where the company is going and they can actually finance the deficit. What do I mean by finance the deficit? Any months or years of unprofitability, they have to be covered by equity raises, right? So if the prospects of the company are great, and then the investor base believes in those prospects, and they assign a big enough market cap to the company, and the company doesn't have any debt, for example, then it's not a big deal. They believe that the company will reach profitability at some point in the future, and until that happens, they are willing to fork more money, yes, which is dilutive, but they are willing to fork more money to bridge that gap until the company reaches the profitability. Now, if they lose the belief that the company has a bright future, then the company's market cap is most likely going to get crushed, and then you have a problem. So measuring the pulse of where the company's shareholders' beliefs are and excitement about a company is one of the factors that determines whether you should get involved in in companies that might not be profitable yet. Another factor is, of course, the balance sheet. The balance sheet meaning how much cash do they have in the bank, how much debt they have, and who carries that debt. Even though the company might not be profitable, but if they have enough money in the bank to carry the company to profitability, then it's not a big deal. But then if you combine it with the previous point, is that even if they don't have enough cash, what is the belief that the investors have? Like if you look at an example of Oracle, Oracle doesn't generate any revenues. So the belief that the shareholders base have assign a certain market cap to the company. And as the cash is running lower and lower, the company came in to the market to replenish the treasury to continue with the program. But this is possible because the shareholder base has a belief that the asset is valuable. If they didn't have the belief that the asset was valuable, then every capital raise would be hugely dilutive. So the balance sheet is important, and also the debt is important. But I personally don't like to invest in companies that have debt. I try to stay away from those companies. But that's again having a tunnel vision. It all depends, because it depends on how is the company doing, how close is it getting to profitability, is it at a danger of not paying off the debt, or how big is the debt in relation to the market cap, and are they breaking covenants of the debt, and if they are, what are the repercussions? Who are the holders of that debt? And perfect example is Voxtur, for example. Voxtur has some debt. It's very small in relation to the market cap, because the debt amount is about $30 million and the market cap is about $500 million. So it's not a big deal when you compare it to the size of the market cap. And one of the quarters, Voxtur was in violation of its covenants. And that obviously worried some people. But because of the type of debt holder or debt owner that was involved with Voxtur, it wasn't an issue, because the debt was held by the Bank of Montreal, and the Bank of Montreal is a huge supporter of Voxtur. They're on the board of directors. They have a very long-term relationship with Gary. Gary made them $500 million over his deals with other companies. So the relationship is strong. So when the company was not in good standing on covenants, the company simply went to the bank and said, look, what do you want us to do? Do you want us to pay you back? Because we can pay you back. We have $500 million market cap. We can dilute for $30 million and we can pay you back today. Is this what you want? No, the bank didn't want that. Okay, so then adjust your covenants so that we can be in compliance to the covenants, so that we can continue growing the company and being on the growth trajectory that you want us to be. And you are also an equity owner in our company, so you own both equity and debt. So the negotiation was beneficial to both parties. But it's just an example of, there's so much more when it comes to these kinds of situations. And in another situation where I talked about Arcana, which was a similar situation, because Arcana was the silver producer, and it had also had a $600 million market cap at a time that Arcana took on debt, which was like $20 million or $30 million debt. So it's similar situation, like similar market cap to what Voxtur has, and similar amount of debt. But what was the difference? The quality of the business. Mining business is a terrible business. They were not able to turn profit. Their asset was awful, and the price of copper declined, was in a bear market. The market cap collapsed, and then that $20 million of debt almost killed the company. The only reason why it didn't kill the company is because the lender took one of the properties, because Arcana had La Negra mine and it had Shafter at that time. So the lender took La Negra and Arcana became with one asset. In other words, it went from owning Shafter and La Negra to just Shafter, which what happened is took the company from being able to produce 2 million ounces of silver per year. Instead of going to 10 million ounces of silver, it went to zero because of the debt. Now, but the business of Voxtur is completely different. The business that they're in is a wonderful business with high profit margins and a huge growth potential, huge addressable market during the time that the industry is in transition, accepting new technology. So the shareholder base has a huge belief in what the company is doing. The CEO or the chairman has done it twice before. And then the relationship between the debt holder and the company is completely different. So it might look the same, it's completely different. That's why it's hard to put rules on or checklists on how you need to approach these situations, because every situation is different, every business is different, every debt holder is different, and the relationship between the parties is completely different. So I hope that you kind of understand, my thinking behind these kinds of variables within different companies. Then the other thing I want to address is the talk about revenues, gross profits, positive EBITDA, negative EBITDA, and how you can view as how to value some of these companies. And again, it's not a straight answer. When you have a stabilized company with stable net income, stable free cash flow that you can project, it's easy to come up with value. But when you have a company that's on the way to profitability, you can value it in several different ways. You can look at the revenues, you can put a multiple on revenues. You can look at the gross profit, which is revenues minus cost of goods sold or cost of services, and then you can put a certain multiple on that. Or you can project what you think the company is going to do down the road in terms of free cash flow, and you can kind of be like, okay, let's say the free cash flow of a company in 5 years is going to be 100 million. Well, what's the 100 million in 5 years going to be worth? Maybe $1 billion or $2 billion, and you look at it, what the market cap is right now, you look at it, what is it going to cost to get there? And you can kind of be like, well, what am I willing to pay for something that I think is going to have a $1 billion or $2 billion value in the future? What am I going to pay for it? Am I going to pay, 100 million for it, 200 million, 300 million? There's no right answer to it, but you can kind of look at it. And to say that you can't value a company based on revenue multiple or based on gross profit is also not correct, because those things are valuable. Just like saying, for example, Voxtur made about $100 million of revenue in 2021. but it wasn't profitable. Does it mean that the company is worthless? Of course not. You can't look at it like this, because to generate $100 million of revenue, that revenue has value. And if you don't think it has value, go out and try to generate $100 million. See how difficult it is to generate $100 million. But it has value because at any point, could Voxter say, you know what, we don't want to grow anymore, we want to be a $100 million business, can we make this profitable? Of course they can. If the business is good enough, they can bring the gross profit margin to a certain level by transitioning all of the clients to the new technology. They can cut the expenses to the bone, and they can show probably $20 million of net income. Bottom line, they can show that. If they wanted to, I have no doubt they can do it. So that's why this $100 million is worth a lot of money, because they could make that choice if they wanted to. But they want to grow it further, so they're making a choice to continue to grow. The same thing when you look at a gross profit. You can put a multiple on a gross profit. I don't know. You can look at some comparables to what the multiple you want to put at, but sometimes if the market is overvalued, the looking at the competitors is not the best way to do. But you can put a reasonable multiple over gross profit, and that's valuable. Why is this valuable? Because when companies acquire each other, and this is very typical for younger companies as they become, grow to medium-sized companies, a lot of them become acquired. And then the acquirers, they don't necessarily look at the bottom line. Why don't they look at the bottom line? Because when they acquire a business, they look at synergies. They look at things like, okay, yeah, I can see that the SG&A expenses are high or sales expenses are too high, but when we get this, we're going to eliminate this, and that, and we're going to make this entity more profitable. And that's why they look at gross profit. They look at what this company is going to do to them, and they're going to value it based on that. And that's why they might put a 4 times or 5 times or 10 times multiple on gross profit if this acquisition is going to help them be accretive. So all of these factors are important. It's not just, it has to have a certain net income or earnings per share for the company to have value. You have to think about it from many different angles. You have to think about how companies acquire other companies. You have to think about how they're making a choice maybe to not be profitable right now because of the future profitability. All of these things come into play when looking at these companies. If you look at examples of like Amazon and Tesla, look at how long Amazon stayed unprofitable. That didn't stop it from becoming one of the largest. They didn't stop it from becoming $1 trillion company. Look at Tesla. It's not even profitable yet, okay? And look at the market cap. So there's no right answer, okay? If you want to be the investor that I only invest in profitable companies, that's fine. You can be an investor like this, but don't think that the people who are investing in close to profitable companies or unprofitable companies, don't think that they don't put any thought into their own investments. Don't just say that they're speculating just because you don't understand how businesses operate or you don't understand their thought process. There's so many different investing styles, so many different ways of looking at investments, and you can be successful in one area or you can be successful in many different areas. So with that being said, that's it for this video. I hope you enjoyed it. If you want to help to grow this channel, you know what to do. Subscribe, comment, notification button, engage with the video to help the Google algorithm. Thanks for watching.